All right, good morning, ladies and gentlemen. For those of you watching the recorded stream a little bit late today, it's going to be a shorter one. But, wow, Match has a great chart. Look at that. That's beautiful. That's a gorgeous chart. Twilio up good. WHD doing pretty good today. Looks like Regeneron giving some back. Twitter NQ. Let's pull up market scan. And this particular one did not maintain that. All right. Sorry guys, don't know why I have to do this all the time. Hey Nick. Good morning, Eli. I'm late today. My alarm went off and I thought I snoozed it. I must have stopped it. So it didn't see? I hate this window. Anyway, what up, Ian? I'm liking Match's look this morning. We got Cron here up a bunch. Ian, maybe go ahead and sell that if you got that. If you took that Cron position like down here, good job. Unless you got a longer term option, then you can go ahead and hold that, obviously. Let's take a look at the leaders of the day. All right, so there's 5. We watched the gap up on that one, and it's been kind of working its way higher ever since. CRISPR coming right up to the trend line, pausing so far. What was up here earlier was Emmys, giving up a lot of gains there. But Emmys was up, WLL. Both of these are petroleum companies. Whiting Petroleum is slowly riding higher there. It's not too bad. There's Match. I like the look of Match this morning. This is a very nice looking pattern. Intrigues me greatly, I will say that. So not quite a double bottom pattern, so you probably have to take 20% profit target off of this. We're down there about 58.50. Would be our potential target, which isn't that far away, to be honest with you. So 58.50 to January would give you a bunch. December would be not a bunch. October would be pretty good. So I think this thing will get to here by October. October 19th to be precise. And that's right where my trend line ends. So I wonder if that's in the cards for Match. Potentially with a nice little consolidation like this, it could rally up pretty considerably there. So Match not doing too bad. Other than that, everything's down, or I'm sorry, up single digits. Let's look at the negatives. Much more down this morning than up. CDNA having a pullback in a long time. First pullback since we rallied out of this little triangle in CDNA. So that's probably a nice little buy point. Volume's a little accelerated here for, 9 minutes in the day. But see if we get supported here by the 10-day. Yep, Facebook, Twitter down. Twitter's down 1.5%. NQ's down. Actually has an outside day today if you look at it. From the futures perspective, you can see right there. That's a full-blown outside day. not so healthy, but give the market a little bit of leeway here. See what else? SNCR. CTSH is lower here. Auto Home, Vips, Holysys, iRobot down 3%. On days like this, you tend to want to look for buying opportunities rather than anything else. But I did see an article on IBD that was interesting, and I didn't necessarily agree with their sentiment, but there's a diamond formation I drew there. Breaking down to the downside. But yeah, investors.com. Oh, what's this one? CoStar nearing a breakout point. They have a comprehensive database of commercial real estate information. They also own LoopNet and Apartment.com, this company right here. It's a later stage flat base. See, now IBD's talking out of both sides of its mouth. What they mentioned the other day is that if you can't find any stocks to buy, it means the market's probably extended. And sorry, I'm looking for the article, but it wasn't there this morning. Let me go to news and see if it's posted elsewhere. I want to bring it up. I'll post a link to it when I get it here. Trump tariff just killed Ford imports from China. That's bad for Ford. Ooh, NASDAQ continuing its lower action here. Well, Ford not doing good. I'm not too mad at that, guys. This is a Monday. This may just be some FUD selling or something. I'm not too mad at that, even though it doesn't look great. Willing to give it some time. Can't find. Anyway, basically what it said was that if you can't find anything to buy, if you're complaining there's nothing to buy, then it's probably time to take profits, is what they were saying. What means later stage flat base and other things you using around bases? So a stock, Twitter will be a good example of this. We talk about cup with handles, we talk about flat bases, things like that. Those are consolidation patterns which are used to get you into and out of stocks. Now, a base, so here's Twitter, here's the ICO day. We had an uptrend, we had a big downtrend, we had a bigger downtrend, and then we started having this kind of larger cupping action. Okay, that itself's not a base. A base is when a stock rises. So this would probably be a loose cup in my mind. If you omit the top half of this circle here, here's your cup, here's your handle. This would be a first stage base. There's no base before it. So here's your prior low. All right, it rallied like a bunch, like 100%. Yeah, 80%. Doesn't have to rally that much, but this would be your first stage base. Okay. Now, as the stock rises, it needs to rise at least 20 to 25%. until it can form another base. Okay, so there's a 40% rise in Twitter right there. And then it forms another cup with handle base. So this is now a second stage base. Yep, perfectly valid cup. So here's your cup, here's your handle, there's your breakout. That's a second stage base. Coming out of this first stage base, here's a second stage base. Now to form a third stage base, you need to rinse and repeat. So this was up 40%. If you notice, about 41.63% right there. And then we went on to form what looks like a third stage base. And actually looks like it's still a valid base. A little deep at 35%. Your average cup base should not be deeper than 33%, but 34% is not bad. So if this rallies back up, we could form another type of a base here, and this would be a third stage base. Now, obviously, stocks can't base forever. Apple's a good example, right? It's not going to base forever. So you have what's called a reset of the base count. And you can reset this base count by undercutting any previous base. So here we have a run up, base, base, base. Not quite a base, so this would be a base on base. And then another base here. Here's a cup with handle, and then a breakout, and then you undercut the low of the base here. And this resets the base count. So then what you have is from here, so there's the resetting of the base count right there. And then when you form another base, like here, this should be a flat base. So this is a flat base. It's under 15% deep. This one's actually 14.5% deep. Actually 15% deep, almost exactly. This is now a first stage base. And then the cycle starts over again. And so you've got, these bases, and anytime you have anything later than a second stage base, a third stage or a fourth stage base plus, and Apple's had like up to 6 stage bases, they're a little longer in the tooth, and they have a higher percentage chance of failing than a first or a second stage base. All right, Nick says, we spoke a bit ago about Roth IRA, and I was curious as to if you would invest in fixed income as bonds, treasuries, especially if when speaking about your kids. Absolutely not. Eli's right. I'm a perma bull on TQQQ. Now, not a perma bull, but I do believe in the NASDAQ, and when the market does top, I will be perfectly happy selling TQQQ, but I do believe in following the indexes from a retirement perspective. Bonds and treasuries are garbage. I ask about the kids due to me being younger and more closely in their scenario, partially due to the personal aspect. I'm not sure what you mean due to personal aspect, but let's do let's do a little bit of rundown here, my friend. Let's go to my handy dandy investment calculator. I like the one from investor.gov because it looks pretty, fairly simple, although they don't like to give you all the options I need. So initial investment, I gave my kids $600. Well, I guess I paid them $600 for being a model for my business, is what happened actually. They took photos for my business. They'll be on my website soon, and I paid them $600. Now every month, I'm not going to do every month, and they have 60 years to save because they're 4 and 7 interest rate. Now the NASDAQ, that's over 60 years. I'm trying to be realistic and thinking how it's going to go. So I'm going to say 15% average growth rate, and I don't think they let you, like if I were to do 24, I don't think it lets me. Oh, it does let me. Sweet, there you go. Okay, so let's do this so I could see a chat if you guys are running here. All right, so The Nasdaq historically. Let's look at historic Nasdaq returns. Historical, compounded. Let's do S&P because it has longer history. This should yield about 8.5 to 9%. Just give me a number. I just want a number. Date range. Here we go. December 2017. Adjust for inflation. Don't include dividends. Wow. 6%? Is that the S&P or the Dow? S&P doesn't go back to 1871. Let's try 1960. 8%. That sounds more reasonable. See, that's the Dow. This is the Dow Jones. That's why it's lower. If you do the S&P, it should be higher. Where does it say? It says growth rate of the S&P. But the S&P wasn't around in 1871. All right, I'm going to find a different calculator. But anyway, okay, August, starting year. Wow, it says 1871. What am I missing here? Oh, they're talking about reinvesting dividends. Okay, well, I'm just going to go with the standard numbers. So let's just go with let's go from the 50s, 1950. So 7.686%. Let's just go with that. So 7.686, calculate. So it's going to give you $600 is going to be $51,000. Well, good, Nick. I do have a different investment strategy from a lot of people. And don't take mine as gospel just because you can talk to me. Okay, doesn't make me more valuable. As a matter of fact, challenge my paradigm. I implore you, and report back and challenge me again. Um, yeah, but I don't know. I think the main investment paradigm I think is flawed, and I think it's flawed at a fundamental level due to the bias of the investors. I mean, you're gonna go to a mutual fund for advice. They're gonna tell you to invest in a mutual fund. You're gonna go, you invest in someone that works for a gold place. They're gonna tell you to invest in gold, and it's just the bias. So everyone's trying to beat the S&P 500 in terms of returns. So keep in mind, 80% of mutual funds do not beat the S&P 500. So therefore, why not invest in the S&P 500? I mean, it seems pretty nominal to me. Pretty normal to me. Okay, so let's look at all right, let's just make this quick. So let's just do 7.6. That seems like the Dow. The S&P does usually about 8%, 8.5%. So that's 51,000, 60,000 at 8%. If you do 15%, it's a ton, 2.6 million. Okay, that's a bunch more at 15%. And then if you go like ultra 24%, you're Warren Buffett. And that's how Warren Buffett got rich. Exactly, basically doing 20%, 22% a year for like 70 years is how Warren Buffett got his money. Hold on a second, guys. I'll be right back. All right, I'm back. Okay, Nick, if you didn't see there, Eli asked you a question about you going to manage it yourself or have someone else manage it. Um, yeah, as a younger individual investor, you have a lot of options, and so managing it yourself is one, and letting someone else manage it is another. From that perspective, you should get really interested in, I think, Investors Business Daily. If you're going to try to manage it yourself, they actually have. They don't have a ton of um, stuff on mutual funds, but they do track. They actually, this is one thing I really like about the IBD method. I'm trying to look for something about mutual funds here. They really do, really, their whole premise is based around what mutual funds do, best mutual funds. So you go to Investors Business Daily, check out the best mutual funds. They have all mutual funds section. It's not the biggest section they have, but it's a good, it's a good, I mean, it's IBD, so it's going to be good. Anyway, you can go to investors.com. Research? Okay, news, best mutual funds. And then here you can, you can check out a bunch of stuff. 16 trillion in assets. And keep in mind they just want the fees from those assets. And just like anything else in life, there's going to be some really bad mutual funds. There's going to be some really good mutual funds, and there's going to be a shit ton of mutual funds in the middle. Your job is to find like what's the best mutual fund. And so here, I've actually never been to this portion of the website, so let's check it out. So they've got their 2018 mutual fund award winners. They track all the mutual funds, and this is how they came up with the strategy that they have. So 10-year average returns, you've got, 15% here. Look at these guys up 12 to a bunch. Best U.S. diversified growth. Now keep in mind the markets have been really good the past 10 years. All right, this is not normal. They've been excellent the past 10 years. So you can search here. I've never been here before. And look at that, closed to new investors. You have one option at no. So these do close. The best ones do fill up quickly because the rich people tell other rich people about these things, and they give them more money than they can handle. Then they close to new investors. So you got to try to get in there while you can, and they'll sometimes have minimum investments. And anyway, so it's really funny. Over the past 10 years, everyone should, pretty much every return since 2008, almost every mutual fund should have really, really good returns. So let's look at this. Okay, so these have symbols like stocks. You can actually pull these up. So let's okay, so diversified, best growth, best blend, best large cap, best mid cap, best small cap, best sector funds, international stock funds. Yeah, lots of lots of red on the screen today. Anyway, you can go through this list, and you mentioned bond funds. Here's kind of my view on diversification. Here's my view on bonds. Here's my view on gold. Bonds and gold in this environment is the worst thing you can do. So look at the past 10-year return on all these 7, maybe 8% in these international bond funds. U.S. taxable bond funds, you're looking at 9%, maybe, looking a little better. All these stock funds up here are double digits. Some of these are 12 to 16%, 11%, 12%. Much, much better than what you've seen out of the bond funds. Also, I won't be able to pull up the information for this, but I did see some information once that mentioned bonds are just as volatile as stocks without giving you the return that stocks give you. So you should, in my opinion, unless we go into a very inflationary environment, in which case you're looking for, if you're looking for high income, then you'd move to bonds like in the 1970s when interest rates were in the teens. Then you would move to bonds. But other than that, bonds I don't think should be a more than a 1% part of your portfolio, to be honest with you. I mean, you're literally hunting for what I believe are the best returns. People talk about safety, this and that, yada yada yada. I don't believe in being not prudent with your money, but what I do believe is if if you're in here to invest, you should invest. I mean, period. And if you don't have time to actively manage your investment, I think investing in an index fund is a great way to do it, because you get, like, if you invest in the S&P, you get diversification across many different sectors, over 500 different stocks. And that's pretty good diversification. It has a very low expense ratio, and you don't have to actively manage it. Now you can go into one of these. So let's pull this one up to see what it does. Odyssey Aggressive Growth. It says aggressive. And usually you can plug these in just like a stock symbol. And there we go. So 2008, let's see how much more information I can get. All right, so yeah, it goes back down to 2006. Goes from 16 down to 7. So it went down about 56%. That's a little bit less than the market. In a bear market, Nick, yes, hold cash. Absolutely. You cash out. So that's the thing about actively managing your portfolio is you want to cash out, right when you start to see topping signals, not immediately, but when you start to see topping signals, when the market starts to look, fuddy, you want to cash out. Like, for instance, I actually cashed out right here. I cashed out right here, and I got back in like over here. Okay, now this one I ended up getting a little bit of benefit from cashing out. That's not always the case. Sometimes you're going to have fake signals, false signals. Nothing's perfect in life, but there's quite a bit of large distribution up here. And then on the day when it started to drop and undertake this low, I got out and then avoided all of this garbage. And then got even up here. I didn't like how it was rising. The stocks weren't looking good, so I didn't get in. So you can time the market. Don't let anyone tell you that you can't. Just because those people can't time the market doesn't mean you can't time the market. All right? So there's that as well. You can time the market. But yeah, so I put, so my kids' retirement, I have them in the TQQQ. So it's just a simple, but this is a NASDAQ ETF, not a S&P ETF, and this gives you triple the performance of the NASDAQ. And so that's why I put 15% in my investment calculator. In theory, it should be like 20 plus percent, but trying to be conservative with $600 going over 60 years. How old are you, Nick? Give me your age, buddy, and I'll plug it in here. I mean, come on, $2.6 million from your dad thinking about you when you were, 3 and 7 years old. I'm actually mad at myself because I thought about opening them up a Roth IRA from the drop from the get-go. So I put $600 in there, but if you go back to when my son was born, my first son, actually kind of upsets me that I didn't do this. So he was born in 2011. He's born January 10th, 2011. 2,000% gain that I missed out on for my kid. So that's same $600. What's 1,000% from $600? That's a 10 bagger. That's $6,000. This is 2,000. So you double that. It's $12,000. I missed out on 12 grand for my kid. In one of the best bull markets in history. So to be honest with you, I feel like a huge asshole. And then I rectified that last Friday. Anyway, that's my therapy session for the day. Hey, Regeneron came back quite nicely, and looks like the Qs are doing okay this morning, coming back as well. Like I said, they like to do stuff for the first half hour of the day. So scare a bunch of people out of their money so they can grab it. And if you don't let them do it, then you can kind of, do good things. So anyway, TQQQ is what I'm investing in my kids, and that's my default cash position in a bull market. Is that TQQQ? So so you're 23, so you're gonna have about 40 years. So let's say you do 15%. Okay, let's say you learn to time the market. You know, look at the difference between 40 years and 60 years. You go from 160 grand to 2.4 million dollars. Wow, 460 years gives you all the money in the world. Look at that, 2.6. But yeah, if you can maintain 50, see, look, you're gonna put a lot more than 600 bucks. So let's say you put 600 bucks in there. All right, I'm just gonna assume you got more than 600. Let's just say 600, and then you do another 100 bucks every month, and you're 23. You don't have to put a ton in to get really good results. And you're 40 years again, so you're gonna have like 4 or 5 million bucks probably. Oh, 2.2 million bucks, and only 100 bucks a month, with only 600 bucks starting. 2.2. That's not too bad. That's not bad at all. Look, we broke the calculator. We broke it. I didn't put anything in. So let's say you want to get really aggressive and do 200 bucks a month. You got 40 years. You're doing 15%, and that's just an average. I mean, you're going to get better over time. There we go. 4.4 million bucks with 200 bucks every month, and that's at 15%. Now, as you get older and stuff, you'll start to do more. If you there's certain money, life money principles you can maintain, Nick, that can put this in the tens of millions of dollars. And keep in mind, this is retirement, okay? This isn't at 29 going to the Maldives with your friends and paying for all of them to go. This is a retirement account. This isn't, trading for income. This is having the expectation of long time discipline with money. All right, and you're gonna wish you had that when you're my age, which is why I'm doing this for my kids when they're single digits, because of that factor, in case they don't have that discipline, because I don't know if they will. I have no idea. And so my plan is to give them their accounts when they're about 30, through their stupid years, hopefully. You're still in the middle of your stupid years, but you're thinking ahead, so you're probably not as stupid as most. Because everyone's stupid until they're like 25, just to let you know. But, so that's not bad. 4.4 million in retirement. Now, that's 40 years from now. Inflation's obviously going to do something with that, but it's kind of hard to get. It's, back in the day, retiring with $1 million meant you were very well off. Today, retiring with $1 million means you can maintain a normal lifestyle. When you retire, retiring with $1 million is going to mean you can scrape by, and then $5 million means you're going to have a pretty good retirement. So it's becoming more and more imperative that you invest earlier and with more. So, anywho, but the whole point of this exercise is to retire well. What you want to do is not be stupid. So all of you stupid people, stop it, okay? Here's an adult. I'm telling you to stop being stupid. And I'm not going to sugarcoat it. It's real crypto, son. I know it's a stock channel, but real crypto, son. Used to lurk around real crypto, got interested in the market, joined Power Hour. Oh, good job there, Nick. That's great. Thanks for joining, by the way. Stop being stupid, real crypto. Exactly. Look, I mean, a lot of people don't want to hurt your feelings. I want to hurt your fucking feelings, to be honest with you, because some people, not everyone, but some people need to be slapped in the face and told they're being stupid. I wish someone would have not literally slapped me in my face, but slapped me in my face when I was younger and challenged my paradigm and said, hey, why aren't you, because I knew all this stuff when I was 18 years old. I knew it all, and I didn't do any of it. I thought that my good market returns would outweigh, any learning that I did, so I wouldn't have to save. And, with hindsight, obviously that's incorrect. If I'd go back again, I would do it again, and I'd probably have a couple 100,000 right now. But, you guys can learn from my mistakes and do. Otherwise, you're stupid. That's quite literally what it is. But I mean, look, like these are literally things that you should never do. Never buy a new car with payments. Just don't. Don't buy a new car with payments. Go buy cars cash. It's really funny, like when you do the math. So I've never really had car payments, but I never invested my money like really well. At least I've always tried to trade. I've never like invested it for retirement. But if you take a car payment and invest it, so let's say you have a car payment of 400 bucks, 450 bucks. Here's your car payment. Let's say you start with a car payment next month. Okay, you put your car payment there, and then you calculate your car. So if you have car payments your entire life, it's going to cost you $10 million. That's a car payment the rest of your life. Quite literally, a car payment. Pretty cool. Pretty cool. So that's a car payment. Maybe a little elevated for some people. So maybe we'll do 350. You know, this is a Corolla. That's a $7.5 million Corolla. That's it. So it's your Corolla is costing you millions of dollars. That's literally what your Corolla is costing you. You've heard of opportunity cost? Everyone's like, I need a car. I need a car. You do need a car. You do need a car. You know, you also need to get off your ass and go work, and you need to save your money. So save your money. Let's go to Craigslist. Let's go to Cars and Trucks. Let's see what we can find on here for like $8 grand. Let's do $5 grand. You know, if you're a car guy like me, it's probably difficult to stomach up buying a used car. But, you know, keeping it real with you guys, go save up. I mean, if you want to buy a really crappy car for like, and keep in mind, guys, this is your future. This isn't anything else. Your friends may laugh at you. Maybe a little hard to get a girlfriend for a little bit, but this one's not too bad. $3,600, and it is a horrible car. It's a Suzuki Sidekick. You don't want to do anything this other than drive it. But there's a Ford for $1,500, $3 grand. So, you know, if you need to buy a car, go ahead and buy a car. But you don't need to spend 12 grand on a car. You don't need to spend 25 grand on a car. You know what I mean? Your future is a crappy car, absolutely. There's no doubt about that. But this one's not bad. 2008 Chevy Impala, 4250. I'm not mad at that. You know, you look like a bona fide Uber driver driving this. That's how you'd pay for your car. So, you know, there's deals to be found out there, but you don't have to go to the dealership and pay a shitload of money for a car. So, you know, by buying cars like this and investing the car payment, I just made you $7.5 million. When you retire, I'll take my 10%. That's it. So, real car. Let's do it. I should do I'll do real trading. It'll just be car reviews about used cars. That's what it'll be. It'll be like, here's a golf cart, $3,750. $2,000 Ford Landscape Limited. Wow, why is that $2 grand? That must be a down payment. No, it says $2 grand. Something's wrong there. That's way nice of a car. So, Ian says, paying cash for my used car was a wonderful decision. Absolutely. So here's the funny thing. Like, I'm 39. I'm older now. If you notice my email address, those of you that have emailed me outside of Real Crypto, my CRX is my email handle. I love these little CRX cars. So I've had these forever growing up. I've owned like 6 of these. They're great, fun little cars. Along the same timeline, 1991 or so, I used to like the Honda Accords. So I found a 1991 Honda Accord like this, but it's a 2-door for like $3,000. And I bought it for $3,200. It was great. I still have the car. It's a great car. Had like 200,000 miles on it. This one's got 153,000. Car handles great, drives great, feels great. Now it's had some issues. I've had to repair some things, but I know how to do that. And actually, Rachel totaled the car once. I bought it back, and now I got my cost basis at $2,500 on this car. You know, But quite literally, if you're going to spend $20,000 on a car, I implore you to go spend $3,000 to $5,000 on a car and invest the rest of that money and begin yourself to your path to your $7.5 million. Crappy car coin. What coin is this? Well, first of all, you're on the Real Stocks channel, and we're talking about compounding returns is what we're discussing. So, um, we're talking about compounding your car payment is what we're discussing today. If you've got a car payment and you're 23 years old, 24, like some of the people in this room right now, and you take a normalized car payment of $350 and you put it in a good investment that gets you 15% return, you have $7.5 million by not owning, or I'm sorry, by owning a car outright and not having a car payment is what we're discussing right now. And guess what? This is the best information you'll ever get in your life. Look, I don't care, like, if you follow Dave Ramsey, he says, pay cash for a house. He says, do all these things. I don't necessarily believe you're going to be able to save enough money to pay cash for a house. To be honest with you, most people aren't going to be able to do that. I don't think you're going to be able to probably have a crazy down payment. But I do believe that you shouldn't own a brand new car, pretty much ever. I mean, this car is going to get you out and about just as well as a Bentley, And if all you're trying to do is live and not try to pretend you're a baller, then yeah, this is what you want right there. That's what you want. I mean, if all you did was that, and then you had a normal house payment, avoided most credit card mistakes, you will be a multimillionaire, hands down. And if you learn to, learn how to time markets and do things correctly, you'll get that 15%. But what if you just do 9%? 1.4 million. Not too mad at 1.4 million either. But by having exemplary returns, 15% plus, you're going to do great. Warren Buffett's compounded money at about 22% on an annualized basis. This is how Warren Buffett got rich. 55 million bucks off of 350 bucks. And this is just you. He did it with other people's money, which is why you put 3 more zeros on this. And that's Warren Buffett. I mean, quite literally, 55 million, he's worth like $60 billion. So he essentially did this. I mean, he's owned the same house since 1955. He's only bought normalized cars. I mean, he bought Cadillacs, for crying out loud. Someone worth $50 billion buys a Cadillac every 8 years. I'm not mad at him for that. So, I mean, this is your best investment advice today that I can teach you is to, get out of your car payment. I mean, if you literally want to be financially secure, I'm not even talking rich, guys. I'm just talking financially secure. Now, keep in mind, this is also retirement, right? If you want to be financially secure and you have a car payment, start searching and start saving to buy a car and then ditch that car payment. Period. Absolutely. Period. That's a good way to do it. Stratwer's got a question. One thing though, Randy, how are the returns after adjusting for inflation? Well, it doesn't. I don't think it matters, to be honest with you, because I mean the returns are going to be the returns. So you're talking about a percentage return on your investment. So this 55 million bucks, if you do 22%, let's say you do 22%, and you're a freaking rock star because you learn how to time the market fantastically. Let's say you do 22%. This 55 million bucks will feel less like 55 million bucks in 2058. We're going on 40 years here on this calculation. So yeah, in 2058, this 55 will probably feel more like 20 million. But the returns will still be the same, so you don't have to really adjust for inflation in this regard. The money's the money, So anyway, that's kind of my rant on investing and things of that nature. And ooh, it's late. It's late, guys. So let's take a look at the markets, and then I'm going to roll. I got to go. So Regeneron coming back here like that. TQQQ coming right back. And QQQ is going to do the same thing here, coming right back. Very nice return to the market this morning. We've got, let's look at some, we got Cron up 13%, coming back strongly after that Citron FUD report. We got Roku looking very healthy. Roku's probably a buy today. It's going to be a good week, I have a feeling. Look at Bitcoin. Yeah, see, Bitcoin's really interesting right here. And Ethereum's really pissing me off because everything's moving but Ethereum, which is pretty stupid. Um, yeah, Bitcoin's interesting right here because this last 2 hour candle right here was looking like a topping candle. You're noticing the volume starting to decrease here as we go higher and higher and higher. This will break eventually and will more than likely cause it to roll over. Now, if this just explodes out on crazy volume, hey man, it is what it is. It can happen, but from general principles, it should begin to fail. I don't mean like right now, but it should start to fail. I don't know when, I don't know where, I don't know how, but yeah. Nick, it's a great question, buddy. It's a great question, and it's important. I do believe it's very important, and a lot of people don't. I just told you very simple things that will make a huge difference, and I hope there's only 10 people here. I wish more than 10 people saw it. A lot of people don't talk like that. They talk about other things, but I'm not keeping my expectations around 10%. Screw that. 10%. That's garbage. You're only getting $1.8 million out of your Ford Fiesta. That's not enough return for a Ford Fiesta. I say get really good. Ooh, I've got 12 now. 12 people here to talk about car payments. So maybe I'll probably do a standalone video about this, guys, to be honest with you. I think it's important enough. And I'll probably do a standalone video, or I'll cut this video apart maybe and do that. But, I think 15% is nominal. Look, I think this TQQQ is going to be around here for a while. The triple the NASDAQ. I think the NASDAQ going forward, there's nothing more techy than tech. And since tech leads the market, I think the NASDAQ's the place to be. Other than that, I would be investing in the S&P triple index fund. But, the tech has been outperforming, so I'm going to stay with tech. You're here for BTC, then go over to Real Dash Crypto. This is Real Dash Stocks. If you found me off of Real Crypto Trade on Twitter, I have my Real Stocks going there as well. Yeah, but if you're here for Bitcoin Forward, if you want to hear me talk every day, I got the Power Hour. You can sign up for that. We talk every day about an hour and a half from now. And yeah, we're Real Stocks right now, buddy. So here's my Real Stocks channel. Here's my stream. So we've got Real Stocks. We got Real Crypto right here. So, I'm trying to get crypto people interested in stocks. A lot of people fight away from stocks, but stocks are great right now. Yeah. I can see how people could be confused. Absolutely. So no harm, no foul, buddy. All good. Well, look at this mutual fund, POAGX, doing pretty good today here. Gotta be a minority? Well, don't you want to be in the minority, Sratra? Don't you want to be in the minority? What's the majority of people like do around you? 6%, 7%? Fuck that. Do better. No, challenge yourself to do better. It doesn't, like I said, it doesn't have to be with stock picking. You can use these leverage ETFs. Yes, Ford, the rising wedge is bearish. Absolutely. It is a bearish pattern. It implies a tightening of price action in a rising situation, which usually means it's kind of counterintuitive. A rising wedge is counterintuitive, but it is bearish. Yeah, exactly. Eating glue and cursing politicians. So, I mean, you want to talk about the minority over the past 12 years? I told you about I'm very mad about myself that I didn't invest in my kids' fund here when TQQQ was $3. Now it's 71. That's not average. So, like, if you invested just in the NASDAQ index fund, I mean, here's average returns, and for the NASDAQ, it's still great. Don't get me wrong. It's like 200%. But 200% right there. But I I would much rather do 2,000% than 200%. Okay, so by being knowledgeable about these financial instruments, you have options. And by being knowledgeable, you have power. And by wielding that power wisely, you have the availability and the hopefully gain the ability to have those 15% returns. And I'm being conservative with 15%. I'm being conservative. I mean, if you compound, the Nasdaq usually does about 9% a year, so that's about 28%. Okay. Now, granted, I say I'm not going to do that, and that's why I say 15%. 7.5 million. I'll be happy with 15%. All right, guys, I got to get out of here, get my kids ready for school. I'm already late today. I'll see you guys tomorrow. Have a good one.